Every day, trillions of dollars change hands on stock exchanges around the world. Fortunes are built and lost in seconds. Yet most people have no idea how any of it actually works. In the next 10 minutes, we're going to change that. From what a share of stock really means, to how prices are set in real time, to why an index fund beats most professionals, to the psychology of bull and bear markets, this is how the stock market works, from first principles. Let's start at the beginning. A corporation is a legal entity that can own assets, hire people, and borrow money. But growth requires capital, far more than most founders can self-fund. The solution: sell fractional ownership. Each fraction is a share of stock. When Apple went public in 1980, it sold shares for $22 each. Those early investors bought a piece of the company. Today one of those shares, adjusted for splits, would be worth thousands. Owning stock means you own part of the earnings, part of the assets, and you have voting rights on major decisions. Common shareholders vote at annual meetings. Preferred shareholders get priority on dividends, fixed payments from profits, but usually no vote. The board of directors, elected by shareholders, hires the CEO and sets strategy. This is equity, skin in the game, shared upside, shared risk. Now the critical question: how is a stock price actually set? Not by the company. Not by regulators. By continuous auction. Every exchange, NYSE, NASDAQ, runs a live order book. On one side, bids, buyers willing to pay up to a certain price. On the other, asks, sellers willing to accept at least a certain price. A market maker sits in the middle, quoting both sides simultaneously, earning the spread. When you click buy at market price, you lift the lowest ask. When enough buyers arrive, the price steps up. When sellers flood in, it collapses. High-frequency trading algorithms react in microseconds, reading news, order flow, options positioning. Earnings beats cause gap-ups. Geopolitical shocks cause gap-downs. Liquidity determines how violently prices move. Large-cap stocks have deep books and tight spreads. Small caps can swing 10% on a single news headline. The price you see is the last agreed trade, a real-time consensus of every participant's belief about future value. Before a stock trades publicly, it must go through an IPO, initial public offering. The company hires investment banks as underwriters. They assess the business, set an initial price range, and pitch institutional investors in a roadshow. On IPO day, shares hit the exchange and open trading. Facebook's 2012 IPO raised $16 billion, the largest tech IPO at the time. After the IPO, the company doesn't receive money from stock trades. That's the secondary market, where investors trade among themselves. The company only cares about its stock price insofar as it affects employee morale, acquisition currency, and the cost of future capital raises. Secondary market trading is a pure transfer of ownership between investors. Understanding this distinction matters. Buying a share on the open market does not fund the company, it transfers ownership from a seller to you. In 1976, John Bogle launched the first index fund available to ordinary investors. The idea was radical: don't try to beat the market, own the whole market, at near zero cost. The S&P 500 index tracks 500 of the largest US companies by market capitalization. Market cap is simply share price multiplied by shares outstanding. In a market cap-weighted index, bigger companies dominate. Apple, Microsoft, Amazon, and Nvidia together make up roughly 20% of the entire index. When Apple rises 1%, the index feels it far more than when a small company rises 10%. An index fund, or ETF, exchange-traded fund, replicates this by buying all 500 stocks in proportion. Rebalancing happens quarterly, winners grow in weight, losers shrink, deletions are replaced. The result? Over any 20-year period, around 90% of actively managed funds underperform the index after fees. Bogle's insight compounded into $40 trillion of passive investment today. Markets don't move in straight lines. They cycle through 4 phases: accumulation, where smart money quietly buys after a crash; markup, where prices rise and momentum builds, drawing in the crowd; distribution, where early buyers quietly sell into retail euphoria; and markdown, the crash, where panic selling feeds on itself. A bull market is defined as a 20% rise from a recent low. A bear market is a 20% fall from a peak. Since 1950, the S&P 500 has experienced 14 bear markets. The average decline was 33%. The average duration was about 11 months. But here is what matters most: every single bear market in history has eventually ended, and the index eventually hit new all-time highs. The dot-com crash wiped out 78% of the Nasdaq. Recovery took 15 years. 2008 cut the S&P in half. Recovery took 5 years. COVID crashed 34% in 33 days, and fully recovered in 5 months. Time in the market beats timing the market. How do you know if a stock is cheap or expensive? The most common tool is the price-to-earnings ratio, PE. Divide the share price by annual earnings per share. The historical average PE for the S&P 500 is around 16. Above that, the market is pricing in future growth. Below that, it suggests pessimism or value. But PE has limits: it ignores growth rate, debt, and sector differences. A better metric is the PEG ratio, PE divided by earnings growth rate. A peg below 1 is often considered undervalued. For growth stocks, analysts use price to sales, since many have no earnings yet. The Shiller-Cape ratio averages earnings over 10 years, smoothing economic cycles. It correctly predicted both the dot-com bubble and the 2008 crash. No single metric is perfect. Valuation tells you what you're paying. Quality tells you what you're getting. The best investors combine both with a margin of safety, buying $1 of value for 50 cents. Let's bring it together. A stock is fractional ownership of a real business. Prices are set by continuous auction, supply, demand, and information processed in real time. Index funds capture broad market returns at minimal cost, outperforming most professionals over time. Markets cycle through bull and bear phases driven by fundamentals and psychology, but history shows they always recover. Valuation metrics like PE and CAPE help you understand what you're paying relative to earnings. The stock market is not a casino, it is a machine for allocating capital to productive companies and rewarding patient owners with a share of global economic growth. If you found this valuable, subscribe. We cover markets, technology, and engineering every week. And check out the for shorts in this series: what a stock is, how prices move, how the index works, and how cycles play out. See you next time.